Good morning and welcome to the launch of RIA's Responsible Investment Super Study for 2021. My name is Estelle Parker. I'm the Executive Manager of Programs here at RIA, and I'm chairing this report launch from Wurundjeri country today here in Melbourne, where according to the Wurundjeri calendar, we're actually in Bawth Guru season, or grass flowering season, which brings the flowering of the kangaroo grass as well as microbats, brown butterflies and other wildlife. And we're finally starting to see, I think, the warmer weather that Bawth Guru season brings. So I'd like to pay my respects to those who've looked after Wurundjeri lands and waters for countless seasons, and to all First Nations elders, past, present and future. And it is my great pleasure to chair this launch of RIA's Responsible Investment Super Study, the fourth iteration of this study. Very pleased to note that RIA now has over 450 members, representing around $40 trillion in assets under management. RIA's purpose, as our members here would know, is to promote, advocate for and support approaches to responsible investment that align capital with achieving a healthy and sustainable society, environment and economy. As you may know, RIA runs working groups. We have our major national conferences. We engage in policy work. And of course, we have our world-class certification program. This study is a product of our research program, which is a key way that RIA supports alignment of capital with sustainability outcomes. So by improving understanding of the state of responsible investment in Australia and New Zealand, we aim to provide you with useful data and insights to help you do your jobs. This morning, we'll hear about the key findings directly from the report's author. Then we'll unpack the findings with a stellar panel. So please feel free to put questions into the chat function and we'll do our very best to answer them as we go. But first of all, a word from our sponsor. Sincerest thanks go to our exclusive super study sponsor, PIMCO. Without PIMCO's support, this study would not have been possible. So on behalf of PIMCO, Victoria O'Keefe, Vice President and Institutional Account Manager at PIMCO's Sydney office and also member of the core leadership team for PIMCO's Global Sustainability Initiative, will now make some remarks. Victoria.
Thanks, Estelle. I wanted to welcome everyone to this super study on behalf of PIMCO. We are thrilled we had the opportunity to partner with PIMCO to deliver this report, because we think research like this will drive continued improvement in responsible investment within Australia and also New Zealand. We want to be an active part of that change. There are so many challenges and opportunities in our world at the moment, and I'd argue they've been exacerbated by the pandemic and financing the net zero transition. And so in this environment, we do get excited when more and more responsible investment and sustainability objectives get adopted by asset owners, because it shifts the way they allocate capital, both internally and with external fund managers like us. We need to see more of this alignment between asset owners, fund managers, and those that need the capital to meet the needs for a more sustainable economy. We must get better together to make this happen. I really look forward to hearing from Zsuzsa on the research findings and the panel discussion today. Thank you. Back to you, Estelle.
Thanks so much, Victoria, and thanks again to PIMCO for your fantastic support to this study. This study comes at a time when we're seeing a huge amount of momentum globally around sustainable investment. Lots of work harmonising standards, increasing transparency, disclosure, putting in place common definitions and so on. Standards really are lifting. And this study clearly shows that in Australia, the proportion of assets held by super funds practising a leading approach to responsible investment is increasing rapidly. Super funds are putting more resources into their responsible investment efforts. They're working to measure outcomes. They're engaging with the companies they're invested in. And for the first time, responsible investment approaches are influencing asset allocation for the majority of super funds. So this report demonstrates all of this and also has some good news about returns. So to take us through all of this and more, it's my pleasure to introduce the report's author. Zsuzsa Banhalmi-Zakar has an extensive record as a researcher. She holds a PhD in sustainable finance and has spent 9 years in academia. She's also worked extensively with investors, the not-for-profit sector and in consulting. She now heads up RIA's research program. Zsuzsa researched and authored this year's super study and will now take us through the report's key findings. Thanks, Zsuzsa.
Thank you, Estelle. Good morning, everyone. Good morning to all our guests and colleagues. Thank you for your time this morning, and I'm very excited to reveal some of the most interesting findings from our report. The report is 37 pages, including the appendices, and includes more than 50 figures and tables. So my job in the next 20 minutes is to present the key findings out of that and some of what I believe to be the most interesting results. So this study targets the largest APRA-regulated super funds in Australia, but we also invite super funds from underrepresented categories to take part, including non-APRA-regulated public entities and faith-based organizations. Our data covers mid-2019 to the end of 2020, with a few exceptions, which are always noted in the report. Overall, in the end, the study included 53 asset owners and representing over 1.9 trillion in assets. The majority of asset owners, as you can see from the top figures, are industry super funds, followed by retail super funds, public sector super funds, and corporate super funds. Industry and retail super funds also have the bulk of member accounts, and the large majority of the super funds are not-for-profit. The study consisted of 70 questions that relied on RIA's framework of good, responsible investment governance to determine leading practice, but more on that on the coming slides. So moving on, the framework itself aims to capture the numerous ways that super funds pursue responsible investment. So it's trying to be all-encompassing. The framework consists of 5 pillars, each covering a different aspect of investment governance. So it is a little bit similar to management systems frameworks for those that are familiar with that. The implementation pillar was divided into 3 parts, 3A, B, and C. It consisted of the most questions because the framework is trying to capture all the different implementation practices, regardless of a super fund's business model. In other words, regardless whether a fund is an industry or a retail fund or the proportion of assets managed internally, whether it employs asset consultants, we try to take all of that into account. The maximum score for each pillar was 10, with each category within the implementation pillar also having a maximum score of 10. But what we did was, if a question was not relevant to a super fund because they don't employ or engage asset owners, then that question was excluded from the total possible score for that entity. Leading practice was reserved for super funds that achieved at least 70% on the framework. Next slide. This year, 13 super funds were assessed as demonstrating leading practice, comprising 25% of the super funds in the study. The total assets of this 13 funds make up the so-called leaders category or leaders contribution, while the other 50 super funds contributed to what we termed non-leaders. This figure shows that the total assets of leaders increased substantially, while the total assets of the non-leaders decreased since 2019. The proportion of change cannot be attributed to market growth alone, which was just below 2% from 2019 to 2020. So what is clear from this is that the leaders are gaining more ground and the non-leaders are, of course, losing a little bit of ground there. The next question that often comes is, what is driving this trend? The top drivers, based on survey respondents, was that they consider ESG investment in ESG an investment decision was to improve financial returns, to manage risk, to fulfill their fiduciary duty, and to meet expectations of their clients or members. In other words, ESG is now widely recognized by the industry as a factor that can impact financial returns in the long term. The next slide shows the second burning question often in relation to responsible investment leaderships and so forth, is how well do super funds practicing responsible investment compare to their peers in terms of performance? So this is actually more difficult to discern than one would think, because super funds offer hundreds of different products at any given time, and each has its own characteristics, making sound comparison between two products, well, difficult, if not impossible. So we rely on APRA's My Super comparison tool. This offers some insight because the parameters that they're choosing basically means that we can compare some of the super funds. So here, the My Super products are compared only based on past 3, 5, and 7-year performance, given an individual who's 40 years old and has a $50,000 balance. Now, of course, not all super funds have an average member age of 40. So some of them might have average ages that are much closer to retirement, which impacts the super fund's sort of investment strategies. So just bear that in mind. Nevertheless, what we see is that the leaders' overall average performance is better over all 3 timeframes. Another thing that we examined in the study this year was gender diversity, and we used APRA data. Unfortunately, APRA data only distinguishes between female and male genders, even though at RIA we recognize non-binary gender identities as well. So with a total of 517 trustees on boards of super funds of the top 53, in this study, 40% are female and 60% are male. So this looks very encouraging, and one might be tempted to say that the industry has almost succeeded sort of in addressing the gender gap, or is almost there. However, when we look at the data in another way, a different story emerges. Individual trustee boards are still primarily male dominated. And of course, then this translates to share of assets as well. Male majority boards are still trusted with the bulk of super fund assets. Encouragingly, we still see a trend that larger super funds tend to have boards that are gender balanced, and that will be on the next slide. But this is happening at the expense of female majority boards, as female majority boards are more characteristics of smaller super funds. And then finally, when we look at the difference in gender composition of boards of leaders and non-leaders, we see that leaders have balanced boards. In fact, leaders have 44% of all of the balanced boards, even though recall that leaders only make up 25% of all super funds in the study. Next up is 2 figures. Now we're moving into the overall trends of the super funds that we studied. The figure on top shows that super funds employ different strategies to manage their investments. However, almost 3/4 of the super funds in our study manage less than 10% of funds internally. So the question is then, how do they make sure that their responsible investment policies, commitments, and beliefs are implemented down the chain? Well, the answer is that they make their external investment managers responsible for it. And that's what is shown in the bottom figure. Fully responsible, largely responsible seem to be the key trends there. Next up is some data on holdings disclosure. The long-awaited regulation on portfolio holdings disclosure have finally materialized in Australia. So we will be watching this space closely over the next year or so as disclosure becomes mandatory with some twists and limitations, I guess. But we are expecting more super funds to join the ranks of the 23% that already provide this information to the public fully. Some of you might wonder why portfolio holdings disclosure is part of responsible investment framework. And the key issue here is transparency. Clients or members should be able to know exactly where their dollars are invested so they can make educated decisions about their super funds. And this whole idea of transparency then is part of the framework, which is part of an effective management system. The figure on the right shows the increasing trend for considering responsible investment in strategic asset allocation. This is an area where I also got a lot of questions around strategic asset allocation. So this refers to the periodic rebalancing of asset allocation between portfolios. So really this is really big. It's really encouraging because what we see is that on an annual or a periodic basis, ESG and responsible investment issues are now being considered at this very important and strategic phase. Next slide, please. Accountability and governance is the first of the pillars of the framework. And accountability and governance for overseeing responsible investment and board level have increased to 92% in 2020 from 79% in 2019. We also see that, which is not depicted on the figure, this emphasis on climate risk assessment at board level at 92% compared to just 74% in 2019 and 64% the year before. Again, these are very encouraging trends because accountability is the fundamental stepping stone or framework for further action. Next slide, please. So this is a bit of a busier figure. It is one of my favorite figures. I just think it's just so rich and so interesting, and there are so many questions that emerged to me anyways, looking at this figure. So what it shows are the asset classes and how the asset classes are included in the funds. So super funds offer a range of products, or also called funds, which are made up of a mix of assets. Assets are usually grouped into these main asset classes that you see on the bottom axis. So there are a couple of things going on in this figure. The red line shows the average percent asset classes in funds. So the biggest asset classes are international equities and Australian listed equities. They both, on average, represent about 30% of funds. The other category, made up of alternatives, growth, defensive, etc., and then property, fixed income, and infrastructure, make up around 8 to 10% of funds. And the smallest proportion of asset classes are farmland and forestry. So that's what the red line shows. Secondly, the chart depicts the different responsible investment approaches used in the different asset classes. So these responsible investment approaches are those that are used in the GSIR, or they're basically the 7 major approaches. And study respondents were given a choice of all of them, but these are the ones that they identified as primary and secondary of importance. So we can see here that ESG integration, represented by the green color, and active ownership, represented by the blue color, are really prevalent across most asset classes. So they're applicable, they're used there. Fixed income is an exception because here we see that negative screening is one of the most common approaches. While active ownership is also used, it's not reflected in this data, but it's not identified as a primary or secondary approach. Sustainability themed strategies are limited in the forestry asset class. So what this may mean for, I guess, super funds is that if they are going to embark on responsible investment and the use of strategy, then ESG integration, or developing their ESG integration capabilities and active ownership capabilities, will probably allow them to address ESG concerns across all asset classes, whereas negative screening is probably more applicable to the fixed income asset class. The other thing, I guess, for RIA and other NGOs would be to look at the largest share of asset classes, because this is where you can make the biggest difference. So watching those asset class categories more closely and what super funds and investment managers are doing in those asset classes. Next slide, please. So we also collect data on resources dedicated to responsible investments, like ESG staff, and how ESG staff are utilized. We found that the number of staff is important between leaders and non-leaders, and that those with a dedicated ESG staff are able to act systematically. We have several research questions probing at this implementation practices. And the message is clear: super funds that demonstrate leading practice ensure that ESG staff are integral to investment decision-making. And this figure, there are several others in the report discussing ESG integration and ESG staff utilization and what's happening in-house. But this figure really demonstrates that difference between leaders and non-leaders. Look at the systematic way, all the different ways that ESG staff are being engaged at key or critical moments in the investment decision process. Next slide. Given that systematic incorporation of ESG factors is key to doing responsible investment well, and that super funds rely on external managers to deliver on their responsible investment strategies, I think this figure is important for asset owners and investment managers both. For asset owners, it shows that one of the best ways to ensure that responsibility for ESG integration is translated further down the chain is to put those expectations into the investment management agreements. And for investment managers, this is a little bit of a warning if you hadn't known or noticed yet, but these are some of the things that might appear in those investment management agreements, and you should be able to demonstrate your capabilities in all of these areas to ensure that you can serve the interests of your asset owners. Next slide. We're still on implementation. This time we're looking deeply at voting. Active ownership and voting go hand in hand. This figure reveals that what issues are discussed and voted upon by super funds. Again, we collected more data on voting practices in our report. The figure on the left shows the different issues that were voted on. Environmental and social factors are right in the middle of the graph, indicating about 50% of funds vote on these issues, but also showing that super funds are more likely to vote on issues relating to decision-making processes, governance, and transparency. On the right-hand side is another figure showing data that were collected for the first time this year on support for ESG-related shareholder resolutions. So we can think of this as a bit of a baseline that we plan on examining into the future, where we ask specifically about ESG-related shareholder resolutions. Figure 23, or next figure, please. So now we're getting close to revealing our leaders, but before then I wanted to show you how leaders and non-leaders fared on the framework pillar by pillar. This graph depicts the average scores on each of the pillars. So the green lines are showing where the highest, where the average scores were the highest, and the red ones are where they were the lowest. So recall that 25% of super funds achieved 70% or more on the framework and were designated as leaders. When we compare these average scores, we see that leaders, so the green, are outperforming non-leaders significantly on all pillars. But the lowest average scores were recorded in the measurement and outcomes pillar number 4. Leaders do well on all pillars, but particularly pillar 5. And non-leaders did also well on pillars 1 and 5. Both leaders and non-leaders did worse than on pillar 4. And so this is obviously, we saw similar results in our benchmark study report on monitoring, measurement, and specifically outcomes. So this is an area of interest to us in the research and at RIA in the coming year. Next slide shows you the performance of super funds on RIA's framework. So this is, again, sort of a visual representation of that cutoff at 70%. And the next slide reveals our leaders for 2021. Congratulations and well done on the work and the effort that you have provided. And I'd like to also thank those that responded to the survey personally, because responding to the survey and just checking those pre-filled documents is crucial to our understanding, increasing our understanding there. All right.
Thank you so much, Shusha. That was a really fascinating presentation of the findings, and congratulations to you on an excellent report. And I second that. Thank you so much to all of those who filled in that survey. It really does help us to produce, well, without that, we couldn't produce reports like this. And congratulations again to those who have been found to have a leading approach to responsible investment. We'll now move on to the panel discussion, which is a stellar lineup. And just a reminder to use the chat function to ask questions, and we'll do our best to answer them. So I'll start by introducing my boss first, the CEO of the Responsible Investment Association Australasia. Simon O'Connor has extensive experience as an economic advisor, investment analyst, and sustainability consultant across the finance, corporate, and not-for-profit sectors. He co-chaired the Australian Sustainable Finance Initiative Steering Committee and is currently chair of the Global Sustainable Investment Alliance. Ross Piper has over 25 years of leadership experience in the corporate and not-for-profit sectors. Ross is currently CEO of Christian Super and Deputy Chair of RIA's board. Lisa McDonald has over 20 years experience in the superannuation sector with a focus on responsible investment and sustainable finance. Lisa is Head of Responsible Investment at Aware Super. Ryan Karinke is Managing Director and Global Head of Sustainability at PIMCO. Prior to joining PIMCO, Ryan worked with the Concord Group real estate advisory firm. And finally, Jessie Pettigrew has a wealth of experience in the development and implementation of sustainability initiatives, including at Westpac Group and in the property sector. She's now Head of Sustainable Investment and ESG Risk at BT. Welcome all. So Ryan, I might start with you. The report shows that the leading responsible investment super funds are now taking a much bigger share of the market in Australia, and it also shows that these funds are outperforming their peers. So my question is performance the only thing that's driving the growth of responsible investment, and what's PIMCO's motivation for implementing responsible investment practices?
Well, thank you very much, Estelle, and thanks for including us on the panel today. I don't think it's just performance. I think it's really driven by the end users. This is a tremendous topic amongst investors around the world. In fact, McKinsey did a study a couple of years ago where they interviewed millennial investors, so sort of the younger cohort and really the fastest growing at this point. And they found that as those millennial investors were making investment decisions, they asked them to describe the top factor, and for 77% of them, the top factor was ESG considerations, and it was only like 11% in which expected returns mattered. So you almost flip those two from what a lot of us have grown up thinking in the investment world, what's most important and what drives decisions. What's interesting is, as I talk to my colleagues, it's very similar. If I talk to my colleagues in Europe, they would tell you that 90% of their conversations with institutional and individual investors have to do with ESG topics and how that's being incorporated in the investment process, how their money is being allocated along those lines. You know, the US is a little bit different. I would say they're a little bit behind places like Europe and Australia that are leading the charge here. But what's interesting to me in the US is where we've seen the most traction would be in the defined contribution plans, where people actually have control over the decisions for their assets versus defined benefits, where the corporation is deciding how to allocate them and ultimately owns that decision. And so again, I think that's the leading edge of where this is all going over time. And so that's quite exciting. For PIMCO, you know, why does this matter to us? You know, first and foremost, it's exactly that point. These are not our assets, these are our client assets, and we want to reflect the things that are important to them in how we make our decisions, and we take the cues from them as far as how they want us to allocate and what they want us to incorporate in our investment process. So that's number one. Number two, though, is we consider ourselves to be risk managers and thinking about carbon emissions and board diversity and all the topics that you can think of in ESG, we think are becoming as important as thinking about duration or curve or credit risk or some of the more traditional things that you would think about as a fixed interest manager like we are. And then finally, we think there's tremendous alpha opportunities. So all of these changes that are going on, the energy transition, the winners and losers geopolitically amongst corporations are going to create opportunities to make excess returns or to lose returns. And so you need to be on top of that in order to continue to generate returns for your investors.
Great, thanks Ryan, that's fantastic. And actually your comments on millennials, it really does support some consumer research that we've done, which showed that in the wake of the bushfires in Australia, 3 out of 4 Australians would actually consider shifting their super fund to one that more aligns with their ethics. And that number actually increases when we're talking about the millennial generation. Might move on to talking about voting. And Jessie and Lisa, you might offer some insights. There's been debate about the independence of super funds voting over company resolutions and the role that proxy advisors play. So can you explain what leading practice active ownership looks like, particularly in terms of voting over shares? Jessie, would you like to comment first?
Sure. Hoping Lisa got first on this one, but that's okay. So look, I think we take asset stewardship as a whole kind of cohort, but within that proxy voting very seriously. It's really a key part of our approach to responsible investment at BT. I think when I explain our process to people, particularly rating agencies who come in to speak to us or members who have questions, I don't think people quite appreciate how much time we spend and the team spends on some of these issues, and how many differences of opinion and different sources of information we take into account when we make these decisions. So at BT, we have 2 approaches to proxy voting. So because we're fund to fund, we expect our managers to vote on every single vote that comes up within their portfolios, where they have the ability to do so. But we also have what we're kind of calling an ESG overlay, where we look at specific issues, so generally contentious issues or issues that are more thematic and systemic in nature. And so for those issues, we take in a huge amount of research, well, I think a huge amount of research. So the views of our managers, the views of community stakeholders, the views of our members. We take in research from research providers we engage, our engagement providers. We also have a set of proxy voting principles, which is available on our website. And so basically what happens is the team sits down, they go through all of that information, they look at our proxy voting principles, they come up with a recommendation. We then sit down with the equities team and talk through how that applies both to the individual company we're talking about and the whole portfolio. And then that recommendation gets approved by the head of equities and or the CIO before it gets kind of distributed to the managers to enact. So it's not, I think people often think that, these kind of things kind of come in your diary and you kind of, think, oh yeah, all that makes sense, and you kind of send it through. But I think increasingly, and Lisa can probably comment on this as well, but I think increasingly these issues are really complex, and there's a variety of different opinions, and overarchingly our intent when we vote is in the financial best interests of our members, and that's really what it comes down to.
Great, thanks, Jessie. And I think that goes to something which we'll touch on hopefully later on, about the involvement of sustainability teams in organisational decision making like that. Lisa, did you want to have a comment on that?
Yeah, great, thanks. And look, it is not a tick the box exercise. I will say that up front. We did the stats for our voting last year, and internationally we voted over 3,000 meetings with 34,000 resolutions. So the role of proxy advisors in terms of, I guess, us adopting a base guideline in terms of what we think good governance is, in terms of what companies should be doing, applying those guidelines to a voting recommendation. And then, as Jess said, and it very much is, particularly at Aware Super as well, we take into account our proxy advisors' recommendation, our fund managers' views, engagement with the company, engagement with other external, so whether we've got the NGOs putting up shareholder proposals, engaging with all parts and all aspects, because ultimately what we are there to do is, as stewards of our members' capital, is to ensure we're investing and we're holding companies to account in terms of their long-term sustainability to deliver returns to our members. When I joined Aware Super, and I'm reflecting on it because I've been here for 15 years this month, all of our managers voted, and they all voted differently. So you're talking about what leadership looks like. So you had mixed votes across all of your companies. So what outcomes were you getting, particularly if you were quite a substantial shareholder in some of these companies? It wasn't really effective. So we brought that in-house in terms of voting the ASX 300 ourselves. And that involves, when there's contentious issues, going to our managers, what's your view? Assessing all of those to make a final decision and voting all of our shares the same way across the portfolio. That is, and having just been through the season and back with my little, really hands-on, there's a tremendous amount of time put into the voting decisions that we make. It is really important that we have all of the aspects and all of the sort of information in front of us to make that decision. And it's certainly, I think the next leadership part, and what we also try to do, is communicating why we might have voted against something to a company. I think that's really important in terms of that transparency and sort of going and engaging with them throughout the year, because what's the point of continuing to vote against something and not get any outcome? So using that stewardship and that engagement and that ownership to actually change the companies. So that ongoing engagement and really being transparent to the companies in terms of why we voted is important as well.
Great. Thanks very much, Lisa. Ross, I might turn to you for a moment. Regulations were recently put in place to require portfolio holdings disclosure by super funds. So why is portfolio holdings disclosure so important for responsible investment? And can you tell us what the challenges are in meeting full portfolio holdings disclosure, and why are so many funds still not disclosing their full holdings?
Sure. Look, thanks, Estelle. And firstly, let me congratulate yourself and the RIA team on a really solid piece of work. It's great to see it being profiled in the way that it is today. So look, I mean, portfolio holdings disclosure remains critically important. It's great to see now a strengthening of legislation and requirements around that. Look, primarily, it's really critically important for consumers to be able to allow them to see exactly where their funds are being invested, gives them an ability to scrutinise underlying holdings, or just to verify if their funds approach is in line with their expectations, and also, really importantly, to see whether a fund is being true to label. We often hear about engagement and trust, etc. So transparency clearly helps to build that trust and confidence with members. And even in our own case, we're quite often approached by members who come with queries on companies they've seen that we hold, or that we've been able to dialogue with them, with our members, on the rationale for why we're invested in those companies. I think portfolio holdings disclosure is a really important element of, very clear and well-informed positions around issues that quite often are not black and white. Our own practice, we've been fully disclosing our holdings since over the last 3 or 4 years. And we've continued to find really material benefits in digging right into the underlying portfolios of our investments. And look, primarily, really, this is just an assurance as much as anything for us to ensure that our investments are in line with our screens. But equally, as I mentioned, for our members, there's a piece here around trust, transparency, and confidence. Look, just very briefly on the challenges, I think there's a number of reasons why this area has been difficult. It's, in principle, it's a great direction for the industry to be moving in, but some of the things that may contribute to why funds may not be disclosing, for example, there could be delays in manager reporting of holdings, and this may particularly relate to unlisted assets or funds of funds. There can be delays in getting up-to-date details of underlying holdings, and in some cases that may be up to a quarter. And certainly in our case, when we receive that data from external managers. So just a timing issue. I think there can be challenges around the lack of look-through to underlying holdings in some types of investments, particularly investments in fund of funds or, for example, collateralized loan obligations or similar instruments. And this information may not often be readily reported, and certainly in many cases needs to be specifically requested. And I think the final element around challenges will just relate to confidentiality provisions around, for example, proprietary screens or manager holdings. And I think this is probably more apparent with active managers. This is less of an issue, I think, when you have an aggregated list of all holdings, but it can become an issue if it's broken down into asset class or by manager. And for us, we found that this is helped by making disclosures with a small time lag, which is our current practice. So I think those are all things that point to some challenges, but again, the broad theme and the encouraging practice and momentum in this space is really positive, we think, for the sector.
Right. Yes, it can be done, as Crispin Super shows. Simon, would you like to comment on that? Why? I think this study shows only 23% of funds are disclosing fully.
Yeah, look, I think Ross has summed that up really nicely, and I think we're really welcoming that the regulations have finally come through to support that and mandate that from March next year. There's some limitations in that regulation still. I think there still is this sort of carve out where you can just name external managers as opposed to underlying holdings. But I think it sort of sets in place a new benchmark where I hope that people will actually go beyond what those regulations are really requesting and see what good practices, because we just know that Australia is a bit of an outlier here as a market on that. Morningstar tells us that in their annual data. We're sort of one of the weakest track records in our disclosure. And to Ross's point, absolutely, the transparency and the accountability to members and clients is key. It's a really relevant point that many of these funds in front of you are holding thousands and thousands of stocks, and it's like a lot of information for a client to look at, and it's quite overwhelming. But nonetheless, we see it as a principle as being really core, because I think increasingly, members do have particular strongly held views on particular companies, and that's going to be very different within a membership base. So, beyond just super funds, though, I think we certainly hope that this starts to translate into fund managers themselves, as well as the clients of the super funds, and so that we see that sort of expanding in the industry beyond just funds next year.
Yeah, great. Thanks, Simon. This is a question for Jessie and Ryan about the team of ESG staff that leading responsible investment funds are increasingly employing. So Jessie, I think you're a good person to start and tell us what exactly does an ESG specialist do? What kind of skills do they need to have? And further to that, this study shows that the specialists, as I mentioned, are becoming core to the investment process, not just an add-on. So how is the role of the ESG specialist changing?
I was really looking forward to everyone else's answers on this one too. Look, I think what does a responsible investment specialist do is an increasingly broad range of things and different things at different companies. So, at BT, we've had a kind of approach to responsible investment for quite a number of years, and yeah, I think we're coming on. Yeah. Anyway, and so that kind of team has built. It's moved around the business as the business has changed as well. There's been different roles. In our context, part of it has always been focused on the investment process, which is largely what we're talking about today. Part of it has been focused on kind of products and services and more corporate process. So it's really melded over time. I think the kind of difference now is that it's really it's always been kind of seen as critical to business. Now it's relatively core. So we're no longer kind of, when we're talking to investment managers, we're no longer kind of checking to see that they're addressing ESG. Now we're really working with our, relevant sector teams to understand how ESG is relevant to this strategy that they're looking to appoint, or to the strategy that's in the portfolio. How does it fit with the other strategies? What are the risks in this particular asset class? What are the skills of this manager? Do we think that is being addressed, from an ESG perspective in this approach? I think when we started this process, it was very much like, does the manager have a responsible investment policy? How are they executing it? Now it's, what outcomes are they reporting? How are they using those outcomes to determine their investment strategy? It's really a much more kind of deep integrated, approach within the investment process. And that's really what we're seeing. I mean, the other thing we spend a lot of time doing, and I obviously really enjoy, is, speaking to people, speaking to our members about what they want and what we're doing, speaking to, panels like this. It's always great, about what we do. And, that I think is really interesting too. It's really interesting to see how many people genuinely are interested in hearing what sustainable investment means in the context of BT and how we apply it. And I think it's, less of a binary conversation now. People are really interested in the kind of the grey and teasing out how the process works. So that's been really interesting too.
Wonderful. Thank you. Ryan, would you like to comment on your ESG team's role?
Sure, absolutely. So I think of there as being 4 key roles that our ESG specialists play, 2 of which are very specific to fixed income, but I think they're important to note. So the first would be coming up with frameworks. You don't have to do this, but we, as a large manager, create our own ESG scores across all of the issuers that we're invested in. And so you need to have some consistency to that approach, whether you're looking at a sovereign or a corporate, or even within corporates. We want our airline analysts to sort of be speaking about things the same way as our media analysts would. And so the team comes up with the frameworks for how those scores might work. They implement the training and make sure that everyone's on the same page. We have 70 credit analysts, and so you can imagine there might be some variance in how they think about things, unless we're very conscious about that effort. And so that's a very important thing. Second one is prioritization. There's so many topics that you could dig into with different issuers, and it gets really tricky. You can get lost in this and spend a lot of time. And so we create things like materiality maps to figure out, here's the things that matter for these industries, don't matter as much for these industries, to really help focus people's efforts when they're digging in with CFOs and CEOs and treasurers to ask questions about what's happening in your line of business. How are you addressing this? What does the trajectory look like? Things along those lines. So that's quite helpful. The third one, which again is very fixed income specific, would be engagement. We don't get to own companies or countries that we lend to. We're a lender, and so we don't get to vote on things like was talked a lot about in the RIA report. But what we can do is, luckily, fixed income issuers come to market quite often, and then also, we're fortunate enough to be one of the larger lenders, and so we can say, hey, like, we don't like how you're doing this. We would like you to address this. What is your plan for diversifying your board more? Oil and gas producers, what's your plan for methane emissions? All sorts of topics you can bring up. And so our analyst team will work with our portfolio managers, our credit analysts, those that are having those conversations with the issuers to make sure those topics are being addressed and to track those and make sure those are being progressed upon as we think about future investments with those folks. And then the last thing is there's a lot of issuance in sustainable bonds. And we need a team to be able to evaluate those. Are the use of proceeds appropriate? Is this, vague and sort of greenwashing, that it's not really projects or initiatives that are going to help things at the end of the day? And so they'll evaluate those and provide guidance to our portfolio managers that, yes, these make sense, these are good investments or not. And so those are 4 of the key things that our team focuses on, at least.
Great. Thanks very much, Ryan. We have had a couple of good questions coming into the chat. I might ask Simon to answer this one. Are super funds interested to make public claims about their responsible investing, and how do they get those claims verified?
I think that goes to the heart of what a report like this does, actually. And it's at a really important time where I think we now see the vast majority of the market having policies and public commitments around responsible investment. What this report aims to do is actually substantiate that there is processes and substance behind the claims being made. And it's only through having systematic approaches across all of these pillars of our framework that you can actually, really substantiate and put the evidence behind the ability of a fund to deliver on the commitments and policies and promises. And so that's part of what we're doing in a piece of work like this. I think additionally, though, in the marketplace, there are people verifying what they're claiming, whether there's external assurance of responsible investment reports, whether that's gaining certification of products through RIA certification program. We get a lot of super funds applying for products that way. And I think that expectation of third-party verification is only going to increase. We're seeing that as a bit of a global trend. And I think that comes at a time where very few fund managers, pension funds, super funds globally do not have some level of commitment here. So now we're at the stage in this market of really being able to help clients, consumers, beneficiaries really be more discerning as to who's doing this well, what does this mean in practice? And so hence the transparency element, that we look at in here is really, really key. But yeah, I think we will see increasing levels of external assurance and verification through certification programs, labeling, etc. And that's certainly a trend we're witnessing with the growth and interest in our program there and certification growing incredibly rapidly right now.
Great, thanks. Thanks, Simon. Lisa, there's a question in there for you about investment mandates and whether you rely on investment mandates over other investment structures in order to enhance active ownership and participation.
Yeah, thanks, Estelle. That's a really interesting question. So for the majority of our investment managers, and we have over 120 external fund managers that we appoint across all of the different asset classes, a number of those will be discrete mandates. So within those mandates, we're able to sort of set out expectations, and we have a number of expectations in terms of integrating ESG reporting and a number of different aspects. And we review that through monitoring of our fund managers as well. However, when you go into some fund-to-fund structures or into some private equity, sort of as a limited partner with the GP, and there's lots of other unit holders in there, it sometimes can be challenging to get specific, requirements from those GPs. However, we have found, and I guess as a large institutional investor, at the end of the day, if a manager wants your mandate, there's certain things that are non-negotiable from our perspective that we expect to be written into mandates, and that's just part part of our due diligence process that we go through. And so within those, they're around reporting, they're around, we expect them to vote, we expect them to engage. It's different from asset class to asset class in terms of what those requirements actually are. But we've certainly found, and we've done a lot of work, we've got quite a large private equity program, and we've done a lot of work with those fund managers and the GPs in terms of transparency reporting and expectations, because that's probably one of the asset classes where there's not a lot of transparency in terms of underlying holdings and look-throughs. And it's really important that we actually know what we're invested in. So there's certainly an expectation. So mandates do play a really important role in terms of expectations of our fund managers. And then, it's about continually monitoring and engaging with those fund managers, and expectations change over time. We've certainly gone from it's about having a policy, as Jess sort of said before, to actually this is what you need to be doing. You need to be reporting on this. We actually use due diligence questionnaires as well with fund managers on climate change and modern slavery specifically, that we want to know what you're doing and you need to report back to us on what you're doing. And then depending on the responses that we get depends on where we focus our efforts to ensure those managers are actually managing our portfolio in line with our expectations.
Great. No, that's great. And I think that really supports this study. It shows that super funds overwhelmingly now expect external managers to implement that fund's responsible investment commitments.
Yeah. Estelle, do you mind, can I go back to the ESG practitioner or the...
Great. Thank you.
I think it's a really interesting where we have found ourselves, having been doing responsible investment since we signed the PRI back in 2008, and that evolution, the pandemic has just exacerbated what we expect of companies or what we invest in from an ESG perspective. If you think about supply chains, workers' rights, it has absolutely exacerbated. And I think it's also then exacerbated the need for specialists or for ESG practitioners with experience or who actually understand these issues in depth. And even if we think about Juukan Gorge and thinking about cultural heritage, did we all as sustainability experts or responsible investment practitioners really understand the complex issues that go to that? We're investing in these companies that are dealing day to day with cultural heritage issues. How do we make sure we're understanding all of those complex, modern slavery, another example. How do we really understand those complex issues to be able to really dive in and drive change? And I think the role of experts or NGOs or organisations that have been on the ground, particularly with modern slavery, and that can be a real help to an ESG team as well. We do not know everything about single issue. And I'm telling you, there's a lot of issues that we're coming across now that we need to be engaging companies with. And I think that's the real evolution of kind of bringing in some of that expertise of some of those different issues in to actually even communicate that to your portfolio managers and your analysts in those different sectors and why they're material and why they're important to those sectors and why we need to be on top of these issues.
Yeah, absolutely, and engaging as well with those at the coalface, like traditional owners. I mean, investors have a key role to play in ensuring that cultural heritage is managed appropriately by the companies they're invested in. You mentioned modern slavery also, that's a key issue. So thanks very much for your insights, Lisa. You mentioned climate. We might move on to talk about climate change. And Simon, the figures in the report show that 92% of super funds now indicate that climate risk is actively assessed right up to board level. So much has been made, of the 2050 net zero by 2050 target, but how meaningful do you think a target is that's 28 years away?
Yeah, so I think this is another one of those issues that's just been accelerated so rapidly, and the data tells us that, the fact that 4 years ago it was only half of fund boards and trustees considering climate change, that's nearly all of them. I think that's a great sort of evolution and progress being made there, and it's really timely because we also see our financial regulators coming out with very clear guidance now on what they expect from climate change risk management and disclosures, and have just in the last week said we expect this to be implemented immediately. So you really don't get much closer in Australia to mandating without mandating climate risk management and disclosures. And so I think it's good to see that funds are at that point today, because what we know is that's going to be a huge topic for funds to continue to grapple with out to 2050. But I think importantly, what's come out of COP and the momentum in the last year means that 2050 is not enough. Now, really, the benchmark is 2030. And all of a sudden, it's not just a commitment we need. You know, what the expectation is what's your trajectory? What are your interim targets? Are you disclosing, you know, progress towards those? So the bar is just lifting so rapidly for funds. And that's good and right and what the science demands of us. But it's a steep learning curve. So I think we're sort of at this point where this is now effectively required. It's good that there's already board level oversight. There's going to need to be a whole lot done underneath that. I think that goes to one of the questions that popped up was something, and it's come up a couple of times, in measurement and outcomes. And, you know, this is one area where we can really come to terms and get our hands around some tangible measurement of outcomes, of how we are tracking and progressing towards net zero commitments. And so I think it was fascinating, that section of the report. And one of the questions was, what does good practice look like? And the way the report's set up is under each of those pillars, there's a nice little breakout box that says this is what the leaders do under measurement and outcome. So I encourage you to read that. But when you look at that section, you see that about 40% are already reporting on outcomes around climate related and environmental outcomes. That's up from like 25%. It's a really rapid increase. But you look at the benchmarks and metrics being used, and there's a list of about 25 different measurement benchmarks and metrics. And so this is what the people who are talking on this panel are dealing with every day. So I think there'll be this convergence. It's really helpful when APRA puts their weight behind TCFD. It explicitly says that in their guidance. This is what will be helpful to, and they've even set parameters around scenarios. So I think we'll see a rapid convergence. And as you've heard here today, you know, that where the state of play is right now is people like Lisa and Jesse and others are now asking their managers for outcome measurement. And then their job is to aggregate those at a fund level so they can start talking to their members about it. So we're seeing some really interesting early efforts on that through the responsible investment reports that some of the funds are putting out. But yeah, I think this is an area we see we can really be helping build the capability and capacity within our membership to continue to improve that area, because that's where the rubber hits the ground. Are we actually heading in the right direction? Is all this work leading to the kinds of outcomes we need?
Yeah, great. Thanks, Simon. Would anyone else like to comment on the issue of targets and outcomes measurement? I'm interested to know as well from the panel, what's the one top action with regard to climate change that a super fund can take now on climate change? Would anyone like to have a go at answering that?
Estelle, I'm happy to. We went through our first year of reporting and on climate in line with the TCFD reporting. I think disclosure from super funds is probably, or reporting from super funds, completely agree, has been lacking. We've all been doing voting engagement, ESG integration, focusing on these issues for a number of years, but what we communicate to our members, and where super was absolutely one of those, we did a lot internally, sort of communicating what we were doing, but not to our external stakeholders on why it mattered and why it's really important that we're thinking about that. I can tell you it caused no amount of sleepless nights and weekends in trying to pull together a stewardship report. But it's brought to life the outcomes, what we voted on, why we voted, what the different issues are, what we're doing, TCFD aligned. It's not perfect, but it's a start. And if we don't sort of start and kind of go, we know we have to improve, these are the things that we're doing, how do we bring them to life and how do we report them? And I think that's one area you'll actually see a huge improvement on from super funds. We've reported, say, against the PRI, sort of benchmarking and put transparency reports out, but I think being able to tell your stakeholders what you're doing and why you're doing it and how it benefits their retirement savings is where we need to get to and what we need to report a lot more on. But it was a huge relief to get it signed off from like our, it's got to go through compliance, it's got to go through legal, it's got to go through 10 different committees that, in terms of getting this signed off, but it's well worth it. And we're already starting now for next year because it's like we need all this lead up to be able to bring everything together and report on it.
Yeah. Not easy, but well worth it. Ryan?
Yeah. Oh, so sorry. So I was going to say on the climate reporting, I think that's a really important issue. 2050 is a long way away. We can all set 2050 targets. What are we going to do in the meantime? So we did a 1 year on report. We've done a TCFD report and we've committed to reporting every year in terms of what we've done in terms of climate change to our members.
Great, thanks. Yeah, so Aware certainly does have a good story to tell in that regard. Ryan, are you able to talk about outcomes measurement?
Absolutely. I think the key point I would make would be in the investment world, we're very keyed on precision, and you can't make mistakes. You know, you would never want your NAVs to be off, your performance, you know, money movement, et cetera. And so that can cause a little bit of paralysis when it comes to things that are a little bit harder to measure, like climate and forecasting what my glide path looks like over the next 5 years, 10 years, 20 years. You know, I notice we get sometimes paralyzed by having long discussions about what assumptions we're making and are those the right ones, and what if we did it this way, and you know, this institution believes in this and this one believes in this, how do we reconcile the two? And I think this is an area where something is better than nothing, and you know, don't let perfection be the enemy of good. And so I would just encourage others, as Lisa mentioned, to you know, move forward, start being transparent and setting goals and measuring things to the degree you can, and recognizing it'll be an iterative process, and don't wait for the perfect answer, because that could be too late.
Great, thanks. Ross, did you have a comment on that? I know Christian Super are sort of pioneers in the area of impact investing, which is obviously at the forefront of outcomes measurement.
Yeah, absolutely. Thanks, Estelle. I mean, I think Ryan raises a really good point here. And as someone who's spent half of my career on the investment side and effectively the other half sitting in the development world, you realise very quickly that development and change is complex. And look, there's a real risk here that we apply, you know, a forensic actuarial approach to try and measure outcomes that are intrinsically multidimensional and are complex. I think Ryan's point is spot on, that you shouldn't let perfection be the enemy of the good. But we also need to be very cautious around applying, you know, a very binary approach to human issues or environmental problems, as I say, that are inherently complex. And of course, this comes at a time where, you know, it's kind of become the sexy thing. If you don't have a statement around 2050 or 2030, you're a bit of an outlier. We're acutely aware of the risk of greenwashing or impact washing, and there's a little bit of a risk of kind of a land grab. We want the headline, we want the statement. I actually think, you know, measurement and the transparency of measurement is critically important. And look, different sets of stakeholders will be on a different trajectory in that regard. Look, for us, and relating to a broader question, obviously we're a faith-based fund. And in fact, there's hundreds of billions, if not trillions of dollars globally that are deployed by faith-based investors. And so it's a very significant tranche of capital. The difference between that, I guess, conviction or set of beliefs is that ultimately, you know, you work on a belief system that goes back thousands of years. It's not necessarily informed by government policy or things like that. And so, you know, there's a different set of drivers, although interestingly, you know, faith-based investors have very often been on the front lines of transformative change in society, you know, anti-slavery, environmental change, things like that. But we have an interesting set of tensions to try and navigate there. Highly engaged members who we hope have a high degree of trust and confidence in the way their money is being managed in line with their deep set values and beliefs. But equally, you know, a risk that you know, you kind of grab the headline, we've divested completely of fossil fuels or something similar to that, almost at the expense of the nuance of some of that. Now, we have real conviction that institutional markets have a critically important role to play to help us transition to a low carbon economy. But that means we may hold certain things in our portfolio that other, let me say, deeper green investors may not. Now, that's okay. The key is that we are transparent about why we hold those things. And you know, we have an ethics committee on our board wrestles with these really deep issues of kind of theology and, you know, environmental science and change and things like that. And what we want to be able to do is communicate with transparency to our members about the positions that we take. They're not necessarily set in stone. I mean, it's a dynamic set of you know, factors that we're considering all the time. But the key is that you've got just really robust process to actually assess your positions, that you're communicating hopefully transparently on that. And I think there's a little bit of a risk in the market that we see an increasing conflation between ethical investing and deep green investing. And I think they're two different things. Clearly they overlap materially. But as you know, one of the very active funds in faith-based investing, we think the nuance is critically important, but it has to be underpinned by accountability and transparency. That's That, I think, is the key for the industry as a whole. And it's really encouraging to see that bar being lifted, certainly from the point of view of disclosures and some of the things that we've covered on this panel as well.
Great. Thanks, Ross. And thanks for sharing some of those unique elements of being a faith-based fund and engaging in responsible investment. Did anybody else have any comments on that? Simon, any comments on sort of the conflation of ethical investing with green investing and so on?
Yeah, I mean, I think ultimately we see it every day, and it's going to be one of the issues we need to kind of confront as a sector, because we will, that conflation leads to accusations of greenwashing, you know, and I think we need to be really clear on what we are aiming to do as a fund and what we're not aiming to do, and really counter those accusations early, because there is certainly a huge risk of greenwashing here right now. There is certainly some examples where people are misleading or potentially misleading with the way they're describing products in the marketplace. But in fact, those that are intentionally doing that, we see as quite rare. What we see is a need for greater clarity in articulating what one fund versus another is actually trying to do. And that's really goes to the heart of, this kind of research to really substantiate the complexity that underpins a good responsible investment process that should be absolutely aligned with the beneficiaries' beliefs and values and should be informed by that. And so Aware and BT and Christian Super and the many other funds are going to have an entirely different approach, which is right because they have entirely different beneficiary groups. And so that's kind of what we're trying to get at. But yeah, I mean, we see it every day that there's a risk here in the misperception from the journos we speak to, from the marketplace. And so so we need to be really on the front foot as a sector, and it's very close to, you know, a big priority for us. And really, you know, the certification program that we apply is all about that, not having language or imprecision in the way we talk about what we do that risks misleading a client, and that's really, really key and core as a threshold in that program. So yeah, very important for this sector right now and over the coming few years, I think.
Thanks, Simon. Look, I think we can't have a discussion about the super sector in Australia without comment on the Your Future, Your Super requirement to act in the best financial interest of members. So, Lisa, has it been difficult to communicate within your organisation that responsible investment is actually in the best financial interests of members?
No, Estelle, we've been doing it forever. So, you know, it's sort of we are fiduciaries. We're investing our members' money. We have always had that philosophy of we need to deliver returns to our members. And the way that we do that is absolutely thinking as responsible owners and responsible investors. And this goes to that convergence of what's ethical, what's ESG integration, what's impact, you know, all the different phrases and languages that we have when it comes to responsible investment. Our approach is to integrate ESG into the investment decisions that we make. And we absolutely believe that thinking about the risks and opportunities of that will drive long-term value creation for our members and therefore drive retirement outcomes for our members. So that is approach we've had for, you know, since we signed the PRA in 2008, and that will continue, and our board is very supportive of that. We have members in the healthcare sector, fire, ambulance. They're on the day-to-day line, like when we think about climate change or we think about the pandemic that we've just had. You know, affordable housing has been a key strategic investment pillar for us because we absolutely believe we can deliver returns to our members, but we can also then provide key affordable housing for our members so they can they can live near where they work rather than having to travel 2 hours to get to work as a nurse. And that goes to that whole do well, do good. We can absolutely deliver good returns as well as benefiting the community and the environment in terms, you know, where our members live, work and retire.
Great. Thanks, Lisa. Ryan, I might turn to you for a moment, just from an international perspective. Perhaps you could comment on what you're seeing as the main trends in the sustainable investment space. And given your experience, perhaps you can comment on the green or sustainability bond market in particular. Thanks.
Absolutely. I mean, what's interesting is the things that I would normally highlight aren't too different than the discussion we've been having today. What I mean by that is, I would say 80 to 90% of the conversations we have around ESG are climate. And so what I'm seeing for sort of the leaders and other investors is wanting to broaden that out and not just focus on climate, focus on other environmental aspects, whether that's biodiversity, water, waste. Also focus on social, and that's become a huge topic in the US in particular, gender and racial disparities and diversity amongst companies and things on those lines, and looking for thematic targeted investments to sort of contribute to outcomes in either one of those. So that's one that I would mention, is just people starting to not forget about climate, but just make sure they're addressing some of these other issues as well. The second would be a little bit of a move from thinking about things in ESG terms to thinking about things in SDG terms. So the United Nations has the Sustainable Development Goals, SDGs, there's 17 of them. And so thinking about, is this investment addressing which one of these goals is it addressing? Is my investment in this company addressing one of these goals, and sort of mapping in that direction? And I think what's helpful about that is it does, help people think about things along the lines of the third trend, which is just an increased desire for impact. So we've talked about it a little bit already today, so it's not new for this group, but just thinking about how can I make my dollars count more and really change real world outcomes a little bit quicker and with a little bit more direct impact and substance that I can see. And so seeing a lot of interest in that. One area that you mentioned that sort of relates to that, it's not a perfect analog, but is the sustainable bond market. We've been very big proponents of trying to get issuers to increase their issuance in that area. And so that's good for us as fixed income investors. It's good for the world as far as the impacts that those projects that the financing can help out with. But it's been great. There's about 2 trillion in assets in USD in that market cumulatively so far. It's been growing tremendously. I think it doubled this year. It was about 900 million or so, or 900 billion of issuance year to date, just through September. We still have the fourth quarter, which is still looking quite strong. And so that's been fantastic as well. A lot of that's been in the corporate space, but seeing more and more from sovereign issuers, from other agencies and supranationals, things along those lines. And so continue to see that. If you ask us, we expect that market to be about 10 to 20 trillion over the next 5 years. And so, we would expect that growth to continue to take place. And so it's a great place to invest and to participate in these areas. Now, again, in that market, the last point I would say would be 75% or so of the issuance so far are green bonds. So it's, again, very focused on the environment, but we're seeing really rapid growth in the other segments. They just, they have ways to catch up: social bonds or sustainable bonds, where it's a mixture of different outcomes. But hopefully that'll continue to develop. So that's another exciting development.
Great, thanks, Ryan. Look, we have one more question, and Ross, I'll ask you to keep this answer to 1 minute. But there was a question in the chat: does a standalone investment option which applies numerous negative screens meet the best financial interest duty?
Look, the short answer is yes, if it's the right investment. I don't think there's anything that links application of negative screens to somehow be counter to the best financial interest duty. It'll come down to the merits of the investment thesis itself. And obviously, hopefully very capable teams seeking to navigate the various tensions, particularly under changes with your future, your super performance test, etc. That's a very live question as funds continue to try to act with conviction on behalf of their members in a shifting regulatory and legislative landscape. Yes, the clear answer is yes, if it's the right type of investment.
Great. Thanks, Ross, and thanks, Ryan, also for your insights on the international developments. And thank you very much to all of our panellists: Simon O'Connor from RIA, Ross Piper from Christian Super, Ryan Karinke from PIMCO, Jessie Pettigrew from BT, and Lisa McDonald from Aware Super. And for more information, please read the report. We're very proud of our research program at RIA, ably headed by Zhuzha. Thanks also to Nicolette Buller, Fiona Silk and Katie Braid for your contributions to this report. And thanks again to PIMCO for your incredible support to this project. And also to Bryony Doyle Galovic for your assistance, as always, in putting on this event. Now, a quick shameless plug for our Responsible Investment Conference. The conference program is shaping up wonderfully. We're going to be discussing all sorts of issues related to how your organisation can thrive in an era of responsible investment. We'll have discussions about climate targets, First Nations people's rights, greenwashing, nature, gender, hydrogen, electric vehicles, impact investing, measurement, and so on. We're going to have a great debate on the age-old question about whether or not divestment is better than engagement. And the program also includes a facilitated design lab on electric vehicles brought to you by the RMIT Centre for Business and Human Rights. And of course, the conference dinner. So we're looking forward to seeing you all personally. And just to note, we'll be including some sessions for those with maybe a little less sophisticated understanding of responsible investments. So do bring your colleagues who you think would benefit from finding out more. This conference is for everyone. And get in early for your early bird tickets. And also please stay tuned for information about our Aotearoa New Zealand conference. See you there, and thank you for joining us this morning.